the 2nd of October 2024. Disclaimer, news events. Right, today I'll talk a bit about the US GDP surge in Q2 and Fed smile over the rate cuts, right? So, the US Bureau of Economic Analysis released its third estimates for the second quarter of 2024, revealing that the real gross domestic product, i.e. the GDP, grew at an annual rate of 3.0%. Now, this marks a significant improvement from the 1.6% growth observed in the first quarter. Economists had anticipated a slightly lower growth rate of 2.9%, but it came out as 3%, which is good, indicating that the economy is performing better than expected. This latest GDP estimates is based on more comprehensive data than the second estimates released last month. This strengthens the confidence that the US economy will continue to expand at a steady pace in the coming year. So with this positive economic outlook, it suggests that labor market conditions are unlikely to experience a significant downturn, right? So in terms of inflation, right, the personal consumption expenditure, i.e. the PCE price index, rose by 0.1% in August, following an unrevised 0.2% increase in July. Now, over the 12 months ending in August, core inflation advanced to 2.7%, up from 2.6% in July. This data supports the Federal Reserve's recent decision, yet suggests that the further rates adjustments may be necessary if labor market conditions weaken. Okay, so with the overall US economy remaining on solid footing, it was no surprise Federal Reserve Chair Jerome Powell said that the central bank is in no hurry to cut rates quickly. Decisions will be made on incoming economic data, with Powell stating, ultimately, we will be guided by the incoming data. If the economy slows more than we expect, then we can cut faster. If it slows less than we expect, we can cut slower. Although the labor market has cooled over the past year, Powell remains confident in its stability, emphasizing that further cooling is not required. I repeat, further cooling is not required to achieve the Fed's 2% inflation target, which means they don't want to see the labor market deteriorating anymore, right? As such, market analysts are predicting that the Federal Reserve will implement additional rate cuts in November and December. The Fed aims to move toward a neutral monetary policy stance, once that neither stimulates nor restrains the economy. Currently, the benchmark interest rate, which was recently lowered to a range of 4.75 to 5%, is seen as restrictive to economic activity. That means it's still high. Okay, it's still high. So during their latest meetings, Fed officials indicate a potential half-point rate cut for the remainder of 2024, which means the total cut for 2024 will be 1%. 50 basis points, which was already done in September, and the balance of November and December will probably see another 50 basis points. Okay. However, futures markets are already pricing in expectations of a further 75 basis points reduction by the end of the year, implying one significant cut in either November or December. Now, when I write here significant, that refers to 50 basis points. And either November or December to have the fifth one of them, to have the 50 basis points, and the balance, one more, will be 25 basis points. That makes up the 75 basis points. Now, this is what the futures is projecting. Whereas if we look at the data that have been released, right, it suggests that so far everything is okay. It's pointing towards probably a 25 in November and another 25 basis points in December. Now, some Federal Reserve officials have left the possibility open for such a move, noting that any signs of significant weakening in the labor market could justify another large cut, i.e. referring to the 50 basis points. Now, if you look at that, right, yesterday when the JOLTS report came out, right, JOLTS saw an what do you call, an increase in jobs opening, increase from 7.71 million last month to 8.4 million this month. The expectation was actually a slight drop of 7.64 million. So with this increase, this is one positive data to the market already. So what will probably convince the Fed, to stay with its own projections, that will be the non-farm payrolls. If the non-farm payrolls on Friday come out anything above 144 and above, I think everything will stay as status quo to follow the Fed's projection. Okay. So that's why I said the upcoming release data will be very, very crucial in guiding the Fed's next policy decisions. So, watch for these things closely, because it will shape the direction of the next monetary policy direction in the coming months. Okay, so with that, that's a report for today.